All right, welcome to YBR Capital. This is your buddy Sid, coming from California. We doing this first and foremost. Happy New Year to everyone. I'm quite sure you've set your real estate goals, and I've set my real estate goals, and we're gonna rock it this year. So I'm gonna be more active this year in 2025 on YouTube. I'm just didn't think actually that investing in rentals could free you up, but I'm seeing the cash flow. So journey so far, decision made in 2022 that hey, does this work or not? Can somebody who is not a professional investor, doesn't work for a hedge fund, can a normal person buy real estate off the MLS, or knowing using their leveraging their networks and be financially free, aka $10,000 in free cash flow? Is it possible or not? That was the question in 2022. So, as with everyone out there, as a new investor, you know, decision to enter the market is the biggest decision. Decision to buy investment property is the second biggest decision, and getting over analysis paralysis is the biggest hurdle of a new investor out there. I'm kind of new, so I feel your pain. So, 2022 decision made. Took me 9 months to get my act together. 2023, I will say April or March, April, I bought my first property, and that was a single family house. Then in 2024, bought a duplex, same time around April, May. That was more complicated, needed to be fixed, got a great deal on that. All the information is in the prior videos. I did a walkthrough, talk about the deal back then live, unfiltered. So the information is there. We'll recap the journey later on. 2025. Sorry, the goal is we're gonna invest in at least one more rental property, possibly a duplex because it cash flows better, and that's the appreciation. Appreciation is not the name of the game. It's a good thing to have, but not what we're aiming for because that's outside our control. So, what I wanted to do today was just give a framework of what I was thinking back then in 2022 as an investor. Should I come into the real estate market? Is it gonna, blow up? So every new investor thinks that they're coming in and the market is gonna be a 2006 and collapsing. Will it happen? I don't know. It can happen based on all the experts who have all been wrong. Is that the market is going to be at 4% growth to flat nationally? Possibly, because as you can see, national market is a conglomeration of 3,000 smaller markets. So it's very hard to predict what's going to happen nationally. But you need to know your market. You don't need to know the national market. You are not Ben Bernanke, okay? You are not Sam Zell, okay? You are not Trump. You are you. So do you, okay? So my markets are basically three markets, which one I don't really invest anymore. So Jacksonville, Florida, that's one of my markets I watch. Indy, Indianapolis, and surrounding areas for cash flow. And Phoenix, because it's kind of near. I'm in California. It's kind of near. I like that market, understand that market, but it's not investable for cash flow right now. The prices have gone too high. Investor activity. There's lots of things going on. So we'll do deep dives into each market, and then you'll see if it makes sense. And hopefully you can use that process to find your market. Don't be like, hey, Sid's investing in that market, I'm going to invest in that market, and I cannot get the returns because there's market identification and is just one of it. Because every year, first of all, every market is different. Okay, so not all strategies work in each market. Okay, within that market, every class is different. So single family, duplexes, A market, B market, C market areas, A, B areas, C areas. Every area also has a different strategy. So you have to find what works for you, what you are good at, what you're comfortable with, and then, find a strategy that works for that particular market, for that particular class, and for you, and implement that. And that is it. As you learn more, from your experience, and as you meet more people and as you watch more content like this, which is real. I'm not a guru. I'm just doing it just to prove it to myself it can be done, given the fact that I had certain background in real estate. I built data centers, so I know how to build those things. I'm comfortable with the construction industry. I've done investment banking. I'm comfortable with the deals. I've done large real estate deals for investors. So having that background, like I was like, hey, if I can't do it, then definitely it's going to be very hard for people unless they have like a special advantage. So that's why I'm saying I'm entering the market with no special advantage except this, the knowledge which you can get from watching this video, reading books. Like knowledge is out there. It's just the implementation and the confidence and getting over your emotions. Analysis paralysis is the name of the game. So what I want to present today is my thought process of when I was going to invest in 2022. I made a presentation for myself to prove to me what's going to happen. Does it make sense to invest in real estate, and is it the right time? Hopefully that will help you understand, if you're a first time home buyer, that is this a good time to invest in real estate? Will the market crash? So let me walk through my thought process, and let's see, if you like it, give me some comments, and we'll do more. Okay, so let's start this. All right. So being a nerd, like I did like the whole presentation to myself, use the logo, everything. I just like to be perfectionist, so that's just my thing. So I hope you you bear with me. All right. So this is where we are. So in 2022, this was the macro picture. So what I was seeing was that, hey, will the market crash? Because that's the first question anyone asks is, hey, is this a good time to invest in the market? Should I be in the market? Does it make sense? So these were the KPIs that I looked at. I was like, hey, what are my investors doing? If the investors are investing, then they must be knowing something that is making sense. And then what is the cost of capital, or what the capital markets are doing? So treasuries were 2%, now it's 4.5%. Mortgages were 4.5%, now it's almost 7.5% to 8% is what you will get. I was looking at this picture. Okay, investors' activity is there, money is cheap. Now, can you afford to sit on your? That's your opportunity cost. Can you afford it? It's the opportunity cost saying stay out because the market is going to change or the market fundamentals are not right. Well, for me, if money is cheap, investors are coming in, then my biggest fear was the house prices will collapse. That is a little hard to do because you have cheap money, you have investors fighting for properties, you have homeowners fighting for properties, and then there's an inventory shortage. So given these three factors, I was like, okay, house prices are not going to crash, even though they are overvalued historically versus that, and we'll come to that point later. But will it crash? No. Okay, then what is your strategy that you want? My strategy is cash flow income versus price appreciation. I'm not betting on price because I don't know what's going to happen. My crystal ball on real estate market. Well, and good thing I had the humility back then to acknowledge that it is broken. So I was like, I cannot predict what price, but what I can predict is income. What I can get after I pay for the mortgage, the OPEX, CAPEX, we can see, and the property manager. Can I make a decent return? And if I can, then I should. Okay, so that was it. So I was like, okay, maybe I can. I don't know, but now I know it's not going to crash for sure. So I'm not going to lose my shirt. So let's move ahead. So then we were like, okay, what's going on? So looked at these markets: Atlanta, Jacksonville, Florida, Phoenix, Charlotte, North Carolina, and Las Vegas. Sounds familiar, right? This is where the investors were rushing in. As you can see, the share of investors in these market on average in 2022 was like 12% and went all the way to 22% by the end of 2021. We were like, whoa, that means that, they're piling in the investors. They've got cheap money. House prices are going to go up. So I need to get in there before things go crazy. I don't know how far it's going to go. And you see the hockey stick curve goes up. So the lesson learned in hindsight now, looking at that point, I didn't have that, but now I'm looking in hindsight, we see that price growth goes up as investor activity goes up, and price goes down as investor activity goes down. So my thesis right now is that there's two drivers of home prices. One is the homeowner, and then is the investor. The homeowners will drive the price to a certain point based on their debt to income ratio, but the investors are the one who invest and speculate, and they are the ones who are not limited by that location. So what I mean by that is salary of a location everywhere is just relative. Okay, you will spend 35 to 40% of your salary on housing. Okay, and if Bay Area salaries are higher, then the house prices are higher because you're still spending 40% of your salary. Okay, out in Alabama, or let's say in Minnesota, the salaries are 50% of what you make in Bay Area, but your housing price is going to be 50% because you're still going to spend 35 to 40% of your take home pay or your gross salary on housing. That is the basis of all local housing markets. Okay, what happened was the game changer was remote work in pandemic, where people making Bay Area salary moved into Minnesota, and they bought like, this is so cheap, and I can pay cash, or I can do this, or I can do that. That caused, it was a blip. Okay, so that blip is disappearing, and prices will revert back to normal. So in those markets where prices have gone up, they will start to steadily go down. There won't be a collapse, or maybe there'll be a collapse, and that depends on the inventory. But based in 2022, the drivers are investors who are gonna go make the local area prices go speculatively high, is because there's speculations, and it's not based on true basis, because they bring in more money that the local economy can support. And that's what I saw, and that's what, if you look back last 2 years from 2025 and back now, you'll see that that's the trend. So and that is the takeaway from us. So looking into the crystal ball, the markets where there were high investor activity are the ones who are going to see the maximum pain, and that is what we're seeing. And in 2025 is once the investors who are going on the speculation side, not on the cash side, are the ones who are going to be selling, trying to get out, and they're the ones who are going to put on the downward pressure on prices. But there's so much demand from homeowners that the downward pressure won't be like a 20% crash. It will be like maybe 5% or like 3% or 4-5%, 3 to 5% decline year on year, because housing takes time. People can suffer pain longer than they wish they can, but they do. So it'll be like 5 years or 4 year downward trend. So yeah, prices may go down 20% in 5 years, but not in 1 year. So that's my premise of my investments continuing forward. So this was the second part. Hey, inventory is going down. If inventory is going down, prices cannot crash. That is like just demand and supply, basic economics. You look at the long-term inventory, yes, 950, 861, 800, so 700. So you can see that average around, let's say 800,000 is your inventory for single family. It was at 300,000. I'm like, there is no way that 500,000 delta will cause the property to crash. Most likely, with all this free money and investor activity, prices are going to go up. So said, jump in now. Okay, you can do it. And I did it. All right, this is like every year somebody will just update the 22 into 25, and like, you never know what is going to prick the bubble. Like, nobody knows. There could be some outlier event out there, we have no idea. Treasury can go crazy, the bond vigilante can come in, Trump spends billions more, there's a new war with China, boom, who knows what the hell will happen. But whatever will blow it, nobody will see it. And then hindsight, everybody will like, yeah, I told you, sir. But based on what I look at supply and demand, it doesn't seem like it. There are specific markets which we identified there with the most investor activity. I think that's one of the videos I will do, is investor activity window what's going on in. Yeah, I think that'd be a good video to follow up on this and see what's going on. So yeah, so an example of house initial analysis I did was like, let's start looking in market. So I'm in California, so I'm like, okay, let's look what's around here. Looking at LA was like, whoa, people in LA didn't suddenly get a pay raise of 100% that versus prior bubble or same in San Diego. This was all Silicon Valley money going down and people just moving from Bay Area shitness. Well, it's a nice area. I'm sure probably shitness, but yeah, there's some problems. But I don't go to San Francisco much, so it's fine for me. But yeah, moving forward, I love California, even though it's not the best place to invest, but I love California. It's nice people, lovely weather. Anyways, so yeah, I looked at Los Angeles again. It's not a price appreciation play. It's I'm not in price appreciation. I'm in cash flow business. So yes, if I want to be in the appreciation business, I can see a case for Los Angeles and San Diego where I invest that, and hopefully, after taxes and realtor expenses, I'll come ahead. So basically, you're looking at minimum 5% is your cost that you bake in. So you need at least 10 to 15% appreciation for you to make sense, which in hindsight, yeah, made sense over there. So will it continue? We'll see. But looking at that fact that hey, housing bubble one in both the cases were were driven by greed and like fraud, and housing bubble 2 is so high, like what is that driven by? And at that point I was like, doesn't make sense, is it going to crash? But now looking back, it's just that the cost of capital was so cheap that people, it unleashed the animal spirits. That's basically is my thought process, is why it went so high. But then it's not supported by the basic salary that people can afford, so they're doing something else. Bitcoin, house hacking, ADUs. I don't know, but they're doing something. We'll figure it out once the tide goes back. We'll see what happened. But I was like, this is not a cash market. I'm not entering here. I look at Minneapolis. Made sense. I was almost there, but then it's somehow the migration pattern didn't make sense to me. I'm like, that's a little too out there, and then people were moving out of that, and only people moving in there was pandemic related, and that's what was going on. I was like, not the best. It's a good cash flow market, but not the best. Denver I liked, Dallas I liked, but the taxes were throwing me off, because see, again, any place which does not have income tax, they're going to get the money. The government needs its money. It's going to get it somehow. And in Texas, they get it through property taxes. So they are very aggressive in raising the the taxes, and valuing your houses much more aggressively so they can get more taxes. As an investor, it's really tough, because as a homeowner you get some benefit, homestead and all that exemption, but investors, they hose you. They like, especially out of state investors, they target you. So I was like, I don't want to be in a place where the government is trying to fleece you. Where is that, California? But yeah, Las Vegas, again, it's an appreciation market. It went up, went down. It's going to do the same thing. Cash flow is very limited, and the people who invest in Vegas tend to be gamblers. So yeah, Denver, I liked. I didn't have a housing bubble the first time. It didn't. People didn't go crazy, and the investor didn't go crazy. But now it's like poof, it has gone up. It's falling down. So I think Denver was driven mostly by investors, and could be a factor that bigger pockets of space there. So like that's ground central. I don't know, whatever it was, but this is what convinced me that hey, this is what is going to happen, and I should start investing in the real estate market, because this is a good time. The prices are going to be held up for the next 5 years, and if my investment in real estate gets messed up, at least I'll have my capital back. So that was the thought process that gave me the confidence of hey, let's give it a shot. It's, let's find a market that's not too expensive and has decent cash flow growth, has decent population growth, has decent job growth. So I identified uh, Jacksonville, Phoenix, and Indy. Uh, Jacksonville and Phoenix has so much investor activity that I couldn't find deals that made sense. Everything was overpriced, so I went to Indy. Looking back, another market I looked at was Cincinnati, Ohio, and that is apparently the best market in 2025 for cash flow. Maybe I should do one for Cincinnati also. So maybe another things I can do is like market deep dive, so you guys can see what's going on in the market and how to invest. And if that's your market, great, you get some free analysis. If not, then you can use the same logic to go into your market and identify the drivers. So that was what I wanted to share for today. I'll try to be more active on YouTube. I just, haven't thought what this channel could be, and any comments, suggestions, always welcome how to go about this. So that's it for now. Thank you for watching the Oz Report and the YBR Capital. This is your buddy Sid. So have a good day, evening, good night, and I'll see you soon. Thank you. Bye.